It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
Tax planning is a crucial part of your financial planning, and it should influence most of your financial decisions. But what if some of your tax planning is actually based on misconceptions and it's not actually improving your tax picture? Today, we're going to share some of the most common misunderstandings around taxes so you can keep more of your hard-earned dollars working for your financial future. That and more on today's episode.
That's right. Tax preparation, tax season is in the spring, but you need to be planning proactively for your taxes all throughout the year. That's the way that you capture opportunities and pay the least amount of tax over your lifetime. We're helping with that right now. If you have a question for the program, we'd love to hear from you. You can call or text us 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com is where you can find us. Leave questions there as well. And then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. Have you ever been doing something that you were convinced was the right thing for you to do? Either because someone told you so or you saw it online, and or maybe a colleague or something influenced you, and you were doing it thinking, I'm doing the right thing, later to only find out what you were doing was actually getting you further from where you wanted to go, like it was wrong. It was a misconception.
I feel like that happens all the time in the world of dieting.
I was going to say the same thing. Yeah. In my health, all the time.
Yeah. I remember as a kid, my dad learning somewhere that the fad was, okay, as long as you're not eating fatty foods, then it doesn't matter what you eat. And so load up on those carbs and those pretzels and everything. And, you know, years later, of course, we find out that no, that creates an insulin response and it's all false. And now you're supposed to eat all the bacon you can. And
right.
I don't know.
And then we'll find out that's a misconception at some point as well. I mean, they're embarrassing. Oxford defines misconception as a view or opinion that is incorrect because of faulty thinking or understanding. And so health, for sure. Finances is fertile ground for misconceptions. And I think there's several reasons for that. But if finances are fertile ground for it, taxes are like the most rich. It's the richest soil. There's so many misconceptions out there when it comes to taxes. And I'm going to say made even worse because of all the tax changes. The U.S. tax code is the most complicated tax code on the planet. And in addition, just thinking about the recent tax laws that were passed, but even the tax laws that have been passed over the past 5 years, no wonder there are so many misconceptions. It's hard to even understand what the rules are.
Yeah, I remember early on in my career, when I was doing financial planning, and this is a show about financial planning, which there are 6 areas. One of the areas is tax planning. And I thought, I'm probably on a scale of 1 to 10, probably a 7 or an 8. And when we hired Scott Anson, who was the first CPA in our tax and accounting department, he started helping me with client issues. And I realized on a good day, I might have been a 2 or a 3. I don't know. But that's the thing about taxes and income taxation and how it applies to your personal financial life is if you don't know about this stuff, it's easy to become confident or even overconfident. Yeah. Because you're like, well, I think I'm doing pretty good. I know some stuff. I took an airplane ride one time and I read a Kiplinger magazine. Yeah. And
now I'm a pro.
Yeah.
That's right.
So I guess, stay humble, my friends. Right?
Well, especially because exactly what you said, all of the changes that have been happening. I remember an episode of this show not that long ago, and you rattled off all of the different tax law changes that have happened just in the past handful of years. And I don't know, just hearing you articulate them and just remind us of them, I don't know. I just get annoyed every time.
We did have a couple fans of the show leave comments on the YouTube channel saying, yeah, you're right. This is getting pretty ridiculous now. It is.
Yeah. Well, I mean, think about talking to a good friend who is a retired partner from one of the bigger accounting firms, and explain to him, well, this is how it works as it relates to retirement plans. And he says, oh, no, it's not. And you're like, well, actually it is. And so there's a little argument until we cite to the source. And he says, oh, well, he said it's not unless it's changed.
Yeah.
And then I showed him, well, it changed in 2023. But these changes, these changes are subtle. They don't make big headlines.
Yeah,
I mean, this is not as exciting stuff as the horrible stuff that happens in the world that everyone wants to be talking about, seemingly.
And yeah, I mean, so here's the thing: you need tax planning. That's the moral of the story. And we've had plenty of banter, but you need tax planning. That's the proactive, creative work to figure out what opportunities exist for you to pay the least amount of taxes either this year or ideally over your lifetime, if not multiple lifetimes. And then with financial planning, looking at all 6 areas, which of those opportunities that you identified with your CFP should you go after, and which of them are good ideas, but they're not right for you, either not this year or not this season. That's what tax planning is all about. With a little shout out to avoiding surprises. No one likes a tax surprise. Let's get into some of the top tax misconceptions, things that you might understand to be true that maybe are not. And I'm going to tell you some of these are nuanced and we could argue about them a little bit here. But the first one is having a mortgage saves you on taxes. And I would say it's a little bit further than that. Having a mortgage that you get to deduct on your taxes actually saves you money. So why is that a misconception? There's oftentimes misconceptions. There's part truths to them, or it might be true for some people, but not for all. Why would this one be a misconception?
Well, I would say in its purest form, if you said, I have a mortgage, I have mortgage interest, and I itemize every year and have itemized deductions, that mortgage interest is deductible, and I'm able to reduce what I would pay in taxes. So in its purest form, that's true. But the reason why it's a misconception is there are potentially a bunch of holes in that. And the first one is, if I had a mortgage balance of $100,000 or $100,000 in the bank, a lot of times people will say, well, hey, I'm not going to pay off my mortgage because it's saving me money. Mm-hmm. And that would be, in that scenario, that'd be a misconception.
Right, because they're saying, okay, I'm paying interest on that mortgage, and if I am itemizing my deductions, which you pointed out, Kevin, and that is a major if, especially these days, because the majority of taxpayers do not itemize anymore. It wasn't that long ago. You don't have to have a very long memory of the tax code to remember a time when actually most mortgage holders, most people that had a mortgage on their house, were getting to itemize. And because it's one of the items that you get to count up. And if you're not familiar with this terminology of itemizing deductions, basically the government gives you a tax write-off. They give you an option. You either get to take a standard deduction that all taxpayers get to take. If you're a married couple, this year it went up to $31,500 now because of the big beautiful bill. It was going to be $30,000. If you're individual, then it's less than that. So the government's already telling you can take that type of deduction unless you can build your own and have it be larger. Now, how do you build your own? You count up the itemized deductions that are allowable, and it's a smaller list today than it was even a decade ago. But mortgage interest is one of them. Mm-hmm. And if you have a mortgage, you get to count that on your way trying to get up over that $31,500. Well, how much of that mortgage interest is getting you to $31,500, and how much of it is actually pushing you over and helping you is another big part of the question here.
Yeah, I would put it generally in 4 buckets: your medical expenses, the other taxes that you pay, your mortgage and other deductible interest, and your charitable contributions. Mm-hmm. So those have to be above, if you're a couple, above that $31,500 number. And one of the things that's changing this year is they've increased the state and local tax limit, because it was $10,000. They've moved up to $40,000. and then there's a phase out there. So this might be a year where you've said, hey, in the past we haven't itemized, but you need to.
Yeah, and so the likelihood that your mortgage interest in having a mortgage is actually going to help you is only if you itemize, but then it's nuanced. More people will itemize because of this SALT tax cap change, but I still think the vast majority of people that have a mortgage aren't getting any benefit. What are some of the other common tax misconceptions? We've got that more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern time every Saturday morning. Also on podcasts at the same time, and also on a couple local radio stations at the same time as well, which is why the content's broken up the way that it is. It has segments, and yeah, it is long form. It's a talk show. There's banter, but also nuggets to help you take your next wise step in your financial life. So make sure you hit that subscribe button, turn on notifications so you're made aware every time we drop new content, this talk show, as well as all the content that we drop throughout the work week. And if you like the content, we appreciate it. Thank you. Yeah. We'll pick it back up, but I think 11% around, and I think they're saying most recent reports, they're just averaging 10% of people actually itemize. And what I saw is with the SALT cap change, they're thinking that could increase maybe to 15%. So still the vast majority of people are not getting a tax benefit from the mortgage.
Right. And so if I live in Indiana, do I get a property tax benefit from my mortgage?
I think they've changed that.
They did.
Mm-hmm.
In
2 years ago?
In January 1, 2023, what they did is they raised the homestead deduction from $45,000 to $48,000 and did away with that.
Yeah, and I mean, good riddance because trying to chase down who has a mortgage, and can you imagine all the people hours, human hours that went into trying to figure that out? And all right, here we go. So we'll pick that back up with a quick comment and then get into the next one. Here we go. What are some common tax misconceptions maybe you're living by? Maybe you've sort of ingrained into your behavior in your financial life that are actually not fully true. They're not actually helping you with your finances. We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com is where you can find us, and then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. Helping with tax misconceptions. The financial world is rife with just untruths, if you will. Well, I thought this was right. I heard this. There was some hearsay that's not actually true. The idea of a mortgage, having a mortgage that saves me taxes, it can only if you itemize. Okay. Most people do not itemize. Before this SALT cap change, it was estimated around 10% of taxpayers actually itemize their taxes. So 90% of people are not getting a benefit on their taxes from their mortgage. With the expansion of the SALT tax limit, I heard that that's going to mean, maybe another 5% will be able to itemize. But still, vast majority of folks are not getting a tax benefit from their mortgage. The other misconception along with this, and Kevin hit it right off the bat, is having a mortgage actually saves me money. If I have the ability to not have a mortgage or have a mortgage, I'll have a mortgage because I want that tax deduction. No. The choice of having a mortgage means you're paying interest. And that interest, the tax benefit, is only a percentage of the interest that you're paying.
Yeah. So let's unpack that, because Kevin, you gave the scenario of if I had $100,000 in the bank or in some interest-bearing investment somewhere, and I have a $100,000 mortgage, the misconception that, okay, I'm saving money on my taxes, so that mortgage is a good thing. You have to pause and recognize that by having money in the bank, you are earning a certain amount of interest, and it's nothing huge. But also by having a mortgage, it is costing you a certain amount of interest expense. And to me, the comparison is between those two numbers, or those rates of return. The rate of return that you're getting from your money in the bank versus the rate of return you're giving the lender by paying interest on that mortgage. And chances are, these days, if you have a recent mortgage, you're paying more in interest on the mortgage than you're earning in the bank. And so you're in a negative leverage situation. You're borrowing at a low rate you're borrowing at a high rate and you're lending to the bank or depositing at the bank at a low rate. And that's the exact opposite of what you really want to be doing in your financial life. The fact that you can save a little bit of money, maybe, in taxes because of the mortgage interest, all that really does is it kind of sheds or shaves off a little bit of the cost to you of that mortgage. It doesn't offset it completely.
Yeah.
So do that analysis, work on this with your financial advisor, and this is some of the balance sheet work that is done when you're analyzing your present financial position. You're looking not only on the cash flow implications of having that mortgage in place, you're also just looking at, is this even a good allocation of funds that I have money sitting in the bank while I could be paying off a mortgage?
Yeah, there was a moment where folks might have had a mortgage and they refinanced, got it down to 3.5%, something like that.
Mm-hmm.
And then short-term interest rates spiked. And so, all right, I've got a treasury bill that's paying me 5%. So sweet, I'm making 5 and I'm paying 3. That is winning.
Yeah.
Yep.
But now, as things have started to settle down and what you can earn, and then the other thing is just what kind of complexity are you willing to allow into your life, and what kind of emotional freedom do you get?
Yep.
Second tax misconception is a gift of more than $19,000 a year is taxable. Get this question. This is all the time. How much can I give someone in a year without it being taxable? Well, what people are typically asking is, what's the annual gift tax exclusion? And yeah, that changes most years. It currently is $19,000. You can give $19,000 to anyone and you don't have to report it on your taxes. But if you decide to give $20,000, not 19, if you decide to give 20, does that mean the extra 1,000 is taxable? No. It just counts towards your lifetime gift limit, lifetime gift exclusion limit, which is millions of dollars.
Yeah. Over $15 million, I think is what it just got moved up to. So in other words, if you gift up to this year, it's $19,000 per recipient. And both you and your spouse could be giving $19,000 to as many individuals as you want to. That $19,000 per recipient does not cost you anything, and it doesn't cost them anything. It's not income to them, and you're not having to pay any kind of gift tax on this. As soon as you go over $19,000 per year, then you start eating into this lifetime coupon that you're allowed to use, which, as Mike said, is millions of dollars per person. So with a married couple, if you each had $15 million at your disposal, you could each give that away during your lifetime and still not pay any gift tax.
I dare you to try.
Yeah, that's right. And if you're looking for names,
go get it.
Yeah. So so this is the thing. If you do exceed that, though, so you're a couple and you say, hey, I want to give $19,000 to one of my children. Okay, well, you can do 19 plus 19. That gets you to 38. And you say, well, we want to give 40. And if you gave 40 in a calendar year, you do not have to pay federal estate tax on that, likely, but you do have to file a Form 709, which is a gift tax form. Because the confusing thing is, how are these things taxed or taxable? And really, when you're gifting someone something, you're gifting the tax status of that gift. So if I'm writing a check out of my checking account, that the money in my checking account I've already paid taxes on.
Right.
So that gift is the children aren't going to pay taxes on that.
Mm-hmm.
If I'm gifting them shares of Apple stock that are highly appreciated, I'm also gifting them my basis, or I'm gifting them what I originally paid for the Apple stock. So the basis travels with it when it goes to my children. So when they sell the stock, they're going to pay taxes at their rates.
Yeah.
And just don't get confused on gift tax versus income tax.
Right. And that's even you would, in that case, you'd be confused with gift tax versus capital gains tax.
Right.
And so there's nothing, I think Mike might have said earlier, there's nothing simple about this tax code that we get to wrangle with. And it isn't. And so you just want to, as you're as you accumulate more, most people accumulate complexity. And so I would be working with a financial planner to say, how do I fight against this and fight for simplicity? And go ahead, Josh.
Well, I was just thinking of, okay, where are some examples of times where gift tax comes into play? And an example that's popping into my head is where maybe there's a family-owned business that is being transferred to the next generation, and maybe there's some sort of a sweetheart deal set up where the younger generation is buying it from mom and dad, and they are doing it on credit. Essentially, they're borrowing from mom and dad. They're the sellers, and they're carrying some sort of a note. It's not that uncommon for that selling generation, the older generation, to maybe have some forgiveness built into those loans. So they're not paying back the full amount, and that forgiven amount ends up being treated as a gift. And again, it doesn't mean that it's creating tax necessarily. It does mean, though, that if you're gifting more than $19,000 per person, you have to do that gift tax return that Kevin was mentioning. And this is just for reporting purposes. It's how you keep track of those lifetime gifts and how much of your lifetime coupon that we were referring to, how much have you used up over time?
And if you looked, just to keep the numbers round and simple, if it's 14 million that I could give away in 2025, 13.99, whatever, that's 28 million. If I give north of that number, then I do have to pay federal state tax.
Yeah, gift tax.
Yep. And that might actually make sense depending on your situation. And if you're listening, you say that there's no way that would ever make sense. It probably wouldn't make sense for you.
Yeah.
But there are folks, and we're working with some right now, where it makes sense. It's a long story, but it makes sense to accept that tax.
Yep. The big idea is proactive planning with your specific financial situation, your unique financial situation, and the tax issues that you're wrestling with, that you're dealing with. You want a guide. Now, as fun as all of this is, I'm just kidding. We are geeks. We love this sort of stuff. You want to be working with a guide who does love this sort of stuff and leans into these rules and then exceptions to those exceptions to help guide you in a way that you can pay the least amount of tax over your lifetime. We've got more tax misconceptions coming up here on the Wise Money Show with Korhorn Financial Group.
All right.
Third segment. This one will be fun. So we'll probably have the last segment be the business ones.
So, because I do have some honorable mentions if we get there.
All right.
That are kind of fun. Because you always tell us to have fun.
I want you to have fun. Yeah.
And you know what? There's nothing I like better than having fun.
Yeah.
Okay.
Yeah, it's fun.
Oh, my word. Okay, Lindsay, can you edit that out? That is going to hurt some people's ears.
Yeah, I know.
And feelings and everything. Okay, so we're going.
Third segment, and we've gone through two of them. So we've gone through two, and we're talking about honorable mentions. Let's hit a couple more. Yeah.
Well, because
you want us to hit your content?
Well, Jared's content.
Oh yeah.
Because what I would, if you look at number 3, and you said, saving into pre-tax 401k saves you money, that actually leads to me, the common misconception is all retirement accounts are taxed the same.
Yep.
And that also leads into I'll always be in a lower tax bracket in retirement, which also leads into the tax laws are always going to work like this. Because if I plan as if the tax laws that are in place today are always going to work like this, I might be surprised.
I think those are all great that you could add right here. And I just also want to point out, if anyone heard that, now we have been talking taxes for 30 minutes, and producer Lindsay just gave an audible yawn. This is the 11th season of the Wise Money Show. I've never heard it.
Yep.
So
that was
it's
loud
either
too.
It's either us.
I hope that came through.
It's either us or it is taxes. So thank you, Lindsay.
Nobody comes into my house and pushes me around.
Oh.
That's who said that? One of the Newt Rockney or someone.
Oh, I don't know.
Pushes us around.
I thought it was
Bo
Schemblacker.
Oh, I thought it was Woody Hayes. No, I
That was for Lindsay.
We would
too.
never-
that was for Lindsay
thing.
though. It's like, okay, this is this studio is the equivalent of a gymnasium, and
never
no one
yawn.
yawns in this.
That's right.
All right, here we go. Third segment.
All right, here we go.
There's some tax misconceptions around saving up for retirement. And it's possible you are taking one approach thinking you're going to have one result when in fact a different approach is best for your financial situation. We're helping that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast wherever you listen. Search the Wise Money Show, subscribe to it there, rate the program there as well. We appreciate it. Talking tax misconceptions, things that you think are true, and they might be actually for some people. But
Right.
because of your specific, unique financial situation, it actually is a misapplication. It's an untruth. It's not appropriate for you. And this third one fits that bill perfectly. And that is, this is nuanced, okay? But that saving pre-tax into a 401k actually saves you on taxes. That could be true, but the point here is it actually delays taxes. It delays taxes. I remember early on in my career, one of the first couples that I was working with, they came to us because they had already went to see a financial advisor, and that financial advisor said, you can't retire. And this person had all the spreadsheets and was convinced that he could. Turns out we did the plan, and he was right. Yeah, I don't know what the other financial advisors saw because it was a slam dunk. However, one of the things that he was touting was, I'd been wanting to save up $1 million. I've got this $1 million saved up. And I started doing the math, and I'm like really young and early in my career, and I'm like, you actually don't have $1 million. You're in at the time 25% tax bracket. You have a statement that says you've got $1 million, but you owe a chunk of this to Uncle Sam, and that underscores this idea that when you save pre-tax into a 401k, you are delaying the taxes. Now, if you're getting a deduction from 22% and you pull it out and you're paying 12%, then yep, you save some taxes on that. But if you avoid 12% on the way in and you pay 12% on the way out, you didn't save taxes, you just delayed it.
Right. And this misconception can lead into other misconceptions, right? So, because one of the common misconceptions, to tie into what you just said, Mike, is that I'll be in a lower tax bracket in retirement. Now, that may or may not be true. Some folks are in a lower tax bracket in retirement. Some folks aren't. Some folks are going to pay more for health insurance when they're on Medicare than they were paying when they were on the company plan. Right. So this is where you want to be doing planning and kind of running those miles, because as long as we're running down the misconception rabbit trail here, the misconception that the tax laws are always going to operate like they do today. Mm-hmm. Who would have thought that they would take the stretch IRA, which was this beautiful concept, which is you can just take a little bit out of an inherited IRA over your lifetime, and said, nope, 10 years. You get 10 years. So now these people with $2 and $3 and $5 million balances in their IRAs are looking and saying, all right, if I don't do something about this, my children are going to pay considerably more tax on this money than I ever thought about paying.
Mm-hmm. Mm-hmm. Let's talk about some scenarios where it is true, though, where contributing to a traditional 401k or a traditional IRA actually will save you money in taxes. And there are times where, just because of the uniqueness of your specific situation, maybe your income is creeping up to certain thresholds and you are no longer eligible for certain tax credits or other savings. And by contributing to a Roth account or not contributing at all, maybe you're avoiding or taking advantage of a tax deduction that would have pushed your income down lower to not only reduce your income this year, but also maybe trigger some availability of things like tax credits, or expand some tax credits for you. And so this is where, man, we never want to speak in too much of a generality, I guess, when it comes to any of these tax shelters, because in your unique situation, one might make more sense than another one. And this is why you need to be talking about this with your certified financial planner in the context of your overall financial plan. But I would also point out that if you can avoid taxes today by contributing to that traditional 401k, and again, you're not avoiding the taxes, as Mike said, you're deferring them or you're delaying those taxes. What rate will you pay when you get out there into retirement and you're drawing off of the account? Because that's when you'll choose to pay the taxes. If you're in a lower bracket in the future than you are today, then you have effectively saved yourself some tax. And it's the difference between what you could have paid when you earned the money versus what you actually paid when you drew the account down and spent it.
And like this, while the future's unknowable, planning and projecting out, you can get a sense for where do you think you'll be. I mean, I'm just picturing here Nate Bargatze in that famous SNL skit where he's playing George Washington. What's in a hot dog? Nobody knows. What will my tax bracket be out there in the future? Nobody knows. Well, you can project that. Actually, we do a tax projection out there within our long-term planning, within our retirement planning, that shows the breakdown of what your income is going to be 20 years from now, 30 years from now. And like Kevin said, the tax laws might be a little bit different, but we can project out based on growth rates and so on where we think your income is going to be, and that can inform your decisions today.
Right. And so I'll give you a little bit of a tricky one if we're kind of nerding out. But if I thought my income was going to be between $500,000 and $600,000 this year,
Yep.
The question is, should I be doing Roth contributions to my 401k or should I be doing pre-tax? Because pretend I'm over 50, and so I could put $32,000 in. I'm going to save 30 cents for every dollar I put into my 401k. And so I would save basically about 10 grand if I made it pre-tax versus Roth, just on the SALT reduction.
Yep. Yeah, you got to be aware of those because saving pre-tax reduces your adjusted gross income or modified adjusted gross income. And like Josh said, there are so many deductions or tax benefits that are based on, well, how big is your adjusted gross income? How big is your modified adjusted gross income? If it's too big, you don't qualify. So saving pre-tax could make you eligible.
But I mean, that puts you in a point where you're saving almost somewhere between 60 to 70% possibly.
Yeah, it's a big deal. Big deal. All right. These next two personal, we've got a few business tax misconceptions. Next two personal, I'm going to lump together. And that is bonuses are taxed at a higher rate, is one. And you pay taxes at the tax bracket or tax rate that you fall into. These misconceptions are very easily understandable. The bonus one has to do with the withholdings when you receive a bonus. The tax withholding tables are far more confusing than you could ever possibly imagine. But when you receive a bonus, it typically, within the tax withholding schedule, we're automatically going to withhold 25%. Typically. Is it 25 or 22%? They withhold a higher percentage, and often they don't even apply it to the tax withholding tables. They just set. On bonuses, we withhold more. And therefore, people have it in their mind that, oh, my bonus is taxed higher. No, it's just that there's more withheld against it because of those rules.
Yeah, if you think of tax withholdings as your way of prepaying your taxes for the end of the year, then it just means that when you got a really large bonus or a large commission check or something like that, and they withheld at a heavier rate, it means that ultimately you're just paying more in for the year. It could be that they're over withholding and you're just going to have a little bit larger refund than you otherwise would have. It's also possible that if you were under withholding and you were on track to have some money owed at the end of the year, maybe they just help close the gap a little bit.
And then the other is we have a progressive tax system, and that's not a political term, and that's not a relative term. That's what they call it: progressive tax system, progressive tax schedule. And that is after you add up all your income, subtract all your deductions, and you get to that taxable income. No matter what tax bracket you're in, or tax situation you're in, marital status, you pay the first chunk, whatever that chunk is, at 10%, the next chunk at 12%, the next chunk at 22%. So if you find yourself in the 22% tax bracket, that doesn't mean all of your taxable income is taxed at 22%. The last few dollars,
Yep.
so if you're in the 22% tax bracket and you say, you know what, we do want to buy this car this year. We need to pull some money out of our IRA. How much should you withhold? 22%, because you're already there. This is going to lop on top of the taxes that you're already paying. But just know that wherever you're at, the first chunk of your income is going to be taxed at 10, then 12, then 22, then 24, and so on. So, all right. What are some other tax planning misconceptions that apply to businesses? Whether you own rental properties, whether you are have a side hustle and you're thinking about an LLC. Does an LLC save you on taxes? What about if you're trying to bring your taxable income down for your business? Does it make sense to just go out and buy some things and get a deduction on that? Is that a tax benefit? So we've got more tax planning misconceptions, that and more coming up on the Wise Money Show with Korhorn Financial Group. All righty.
Can we come back to that tax brackets topic there for a moment?
Yep. All righty.
And are we landing the plane?
We're landing the plane.
As Mike would say. So, and we have how many more?
Well, it's business one, so we hit the 5 personal, and so I've got 3 of them teed up, but we can only hit 1. We can hit 2. We can go on a.
Where do you want to go here, Joshy?
Oh, he wanted to
just a comment about the tax brackets and planning.
Okay.
But yeah, we've got room to run if you've got something else that you think would be applicable.
Do you want my bonus ones?
Sure.
Okay.
Yeah.
I'll throw them in.
All right. Here we go.
Most of them have kind of been a little bit touched on, but
okay.
Well, Josh, you lead off. I'll be in the 4 hole.
That's
bet and clean up.
What they call it.
I don't know. I can't believe how people talk these days.
I know. All right, here we go. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show, as well as a lot of other content, is on the Wise Money YouTube channel. Go check it out. Go to YouTube, search the Wise Money Show. Subscribe to it there so you're made aware every time that we drop a new episode, which is this what you're listening to right now, our weekly 1-hour talk show that airs every Saturday. But we also have Next Wise Step videos and other videos that air all throughout the work week, Monday through Friday. A new video every single day helping you take your next wise step in your financial life. So go to YouTube, search the Wise Money Show, subscribe to it there. Talking tax misconceptions, mistruths, but also it might be a truth to someone else that's not a truth to you. An example of this is Medicare. We're all familiar with that. Well, what Medicare means to one person might mean something different to someone else. Did you choose traditional Medicare or did you choose Medicare Advantage? There's the same thing, Medicare, that are 2 very different things, right? Taxes are ripe with those same misconceptions as well. We left off with progressive tax rates. Josh, what else do you have?
Well, yeah, we were talking in the last segment about how we have these marginal tax rates or different tax brackets that people progress through. As your income goes up, some of your income's taxed at 10, some at 15, some at 22, and you just keep going up from there. I think it's important to just pause and recognize, and this is maybe something you need to do every single year. Look at where are the edges of those tax brackets and where are you falling within the tax bracket. This is a big part of the conversation that you need to be having with your certified financial planner. And it's part of the reason why we do tax projections, because we want to know how much room do you still have in some of these tax brackets to take some helpful and proactive action. An example of that would be we talk all the time about should you be doing a Roth conversion? Well, you may hear us say on this show that if you're in the 15% tax bracket, you ought to be doing some Roth conversions because that's such a low rate, not only by today's standards, but by historical standards. So if you could take money out of your traditional IRA and get it into a Roth IRA and only pay 15% in between, for many people, that is a really good deal and you wouldn't want that opportunity to slip by each year. But you have to also recognize that just because you're in the 15% bracket, you may have some limitations on how much of that Roth conversion you want to do. Because what if you're up near the upper edge of the 15% bracket and you really can only convert 5,000 or 10,000? You wouldn't want to go into it and convert 20 or 30 just believing that, oh, I'm in the 15% bracket. This is a good idea. Because some of that Roth conversion might spill into a higher bracket than what you really intend. The opposite can happen as well. When you're taking deductions, when you're contributing to a traditional IRA or taking certain write-offs, you're going to get a bigger benefit for that in the higher tax brackets. But if you're just barely into the 22% bracket and you say, well, I want to contribute all my money each year for retirement to the traditional side of my 401k, it's possible that some of those contributions are squeezing down the amount of tax that you're paying at 22%. But it's also possible that it's pushing you down into the 15% bracket where you're not really getting as much bang for the buck.
12%. But gotcha.
Thank you. Thank you.
I gotcha.
I'm stuck in the past.
So, but yeah, I mean, being aware of those limits, Josh, that is a huge part of the planning process, and we go over it every single year when we're delivering taxes and going through tax projections. We put the schedule out, and okay, this bracket or this amount of income to this amount of income is taxed at 10%. This to this is taxed at 12. This to this is taxed at 22. Just so you're aware of those limits. Kevin, before we get into a couple business misconceptions, you've got a few other honorable mentions to hit.
Yeah. One of the things is a common misconception. I inherited a house from my parents. I'm going to owe a ton of taxes on this. And that is typically that's a misconception. I've seen people look at that and be kind of frozen. That, it's kind of, finances are interesting because you say, well, it's just the money. It's not. It's the money and it's my emotions. Yeah. And if I get stuck emotionally, I'm not doing anything with that house. And I just recently ran into some folks, and they actually had a couple houses, and they were trying to figure out that they had inherited what to do, and they just didn't want to do anything because they didn't want to pay taxes. But what happened was, because they knew mom and dad had paid very little for the houses, and the houses were worth a lot now. Well, they were what they pay taxes on is the difference between the date of death value and the current value, which it hadn't appreciated very much at all. So I was able to encourage them, hey, let's get those houses sold. You don't want them. You don't want the maintenance. You don't want the utility taxes, all this other stuff. So if you said, okay, what would I like to inherit? I'll tell you what I would like to inherit. I want life insurance proceeds.
Oh, I was going to say Bitcoin, but sure.
So, well, with Bitcoin, you get a step up in basis.
There you go.
But I mean, so if you went down the line, you'd say, I like life insurance proceeds. I'd like savings and checking accounts because that taxes have already been paid. I could also handle an investment account that is just stocks or mutual funds. I could handle real estate. My least favorite thing to inherit, and what most people inherit because it's the tool that is the most efficient for accumulating wealth, is a retirement account.
Yeah.
And that likely the receiver, the beneficiary, is going to be paying the tax on that account.
Isn't that interesting? Because that's what your tax shelter strategy, that's what you should be saving up into. But then when you leave it to the next generation, or if you're a recipient of the previous generation, that's cumbersome. That's a challenge. Therefore, you have to have a long view, and you need to be planning ahead. Well, how do I optimize and use these retirement accounts and my tax shelters, but also am mindful, if you will, if you're expecting to leave a legacy and leave an inheritance, how are you mindful of the next generation and the burden that could place on them? Right. So it's both. It's balance.
Another tax misconception, or even a tax surprise, is capital gains only applies when I sell investments. And you think, okay, well, if I didn't sell anything, I'm not going to be facing any capital gains. But you may have either stocks that pay dividends, or you might have mutual funds that do a dividend or capital gain distribution. Yeah. So you say, all right, I might be paying taxes there. Another one is I got a tax refund, therefore I did something right.
Ah, yeah.
And that one can be a little tricky because you say, hey, I might, and you might have done something right, So that's where it's not perfectly true that you've done something wrong if you've gotten a refund. I know most folks, it's just emotionally, it's a win. It feels like a win if I'm getting some money back, but you got to look at how much you're getting back, because if you're getting a lot of money back, it may mean that you should have had either some more money in your check to live on, or you could have even put some more money in your retirement plan at work.
Yeah. Yeah, those are absolutely all applicable, all good. We could spend a long time talking about tax misconceptions. There are so many. Let's sneak in a couple here for businesses. Get this one a lot when someone's starting a new business or has a side hustle, and we talk to them about setting up an LLC, or they might even ask, should I set up an LLC to save on taxes? Guys, let's blow that one up.
Well, so an LLC is a legal structure, and so you say that can help me for liability protections. Mm-hmm. And if you don't do a different election, it can also be...
but you're also bringing it up like, well, don't forget, you want to do this separate election. No. It might not make sense. An LLC could still be taxed as just a sole proprietor, or you can make an election to have it be taxed as an S Corp. An S Corp might save you on taxes, but it might cost you a lot of money as well, depending on how much revenue and how much profit you have. So an LLC in and of itself, it's a legal structure. It's not a tax benefit per se.
Right. The tax deductions that you would have taken as a sole proprietor before you created the LLC, or as a partnership before the LLC was created and is still taxed as a partnership. In either situation, the tax write-offs are the same.
Yeah.
And sometimes the tax filing is identical as well.
Yep.
Right. So if you don't do anything, your LLC is your legal and your tax structure. You can make an election so that it's just your legal structure, but not your tax structure.
Another big one for businesses is I should buy this thing because I'm going to get a deduction. Well, you might be buying something that you have to depreciate, and therefore you've got a lot of cash outlay, but you don't get a full deduction for it. Some of those rules are changing a bit and expanding it, making it a little more lucrative. But work with your CFP and CPA to make sure that you're managing what expenses are necessary, and therefore which one should I sneak into this year versus next year. All right. You need tax planning, the proactive tax work with your certified financial planner, collaborating with your CPA to identify tax opportunities and know which ones to implement, which ones not to. That's all the time we have for today. On behalf of Josh Gregory, Kevin Corhorn, all of us at KFG, have a great weekend. We'll see you next Saturday for the Wise Money Show with Corhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Corhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.